Yeah. It's the mayor of Magaville, baby. Hey, you know who we voting for? We voting Donald Trump, baby. America needs saving. America needs saving. We voted Trump, baby. November 5th, we going crazy. November 5th, we going crazy. Red pill poppin', swerving in the Trump trunk. Republican 4G, Antifa knows what's up. Red, white, and blue, mega nation, throw it up. Black, white, and brown, all about a Trump. Democrat party gon' take your freedom. Indicting our president cause they can't beat it. It's a two-tier justice system. Put America first, we the big. FJB, FJB. FJB, FJB. FJB, FJB. Let's go, Brandon, sing it. We voting Donald Trump, baby. America needs saving. America needs saving. We voted Trump, baby. November 5th, we going crazy. November 5th, we going crazy. Now I pledge allegiance to vote for Trump. There's a red wave coming, you gon' surf for what? And God I trust to take the devil away. Lock Joe Biden up and throw the key away. Your propaganda ain't gonna work on me. Bidenomics is like you working for free. I demand reparations from every idiot that voted for Joe Biden, boy, period. Period, Sleepy Joe is a fraud. And the bloodbath in the Oval Office. The media is the enemy of the people. The Democrats and the fake news always cheat. FJB, FJB. FJB, FJB. FJB, FJB. Let's go, Brandon, sing it. We voting Donald Trump, baby. America needs saving. America needs saving. We voting Trump, baby. November 5th, we going crazy. November 5th, we going crazy.
Good morning, everybody. Welcome. You're watching on the Smart Money TV network on your TVs in Texas and Louisiana, as well as joining from around the world on X and YouTube and Instagram and Rumble and all the other ones. It is always a pleasure to do the show for you. Hats off to our team at Smart Money Culture TV for putting together this TV network, as well as my main man Matt Dixon, my brother David, and the rest of the team that are involved. Of course, I started out the show again with MAGA. This is kind of our anthem now. I mean, I think that he calls himself Trump's nephew. Pretty fun song that he has there. I'll tell you what, guys, the star power, I talked about it yesterday, the star power that we have now between Trump and RFK Jr. is just, it's blinding. It is blinding, the star power that is coming out of those two. And I know, JD Vance is on the ticket as VP, but I mean, JD who? Like, whoa. We have these two guys. I mean, RFK Jr., I mean, the guy, well, first of all, he's just such a stud anyway, right? And he's his father was assassinated, his uncle was assassinated. This historic figure. Then you have Trump, just like a giant of a person. It's crazy times. It's crazy to think that people can think that they can beat these guys. But we'll see. We have everything is on the ballot, and I say hopefully it's on the ballot because hopefully we'll be able to vote ourselves out of this. I am not convinced that we're going to be able to vote ourselves out of this, but everything's on the ballot right now. Your right to have your own thoughts, your rights to have secrets, your rights to communicate with each other privately, and not have a shadowy cartel that is allowed to read everything and know everything. Your right to actually own something. I talk about it sometimes. Like, I mean, even your house. Yeah, you totally pay off your house, and then you don't pay your taxes, and they take it away. The thought of ownership, the right to actually own something, the right to actually own things, and that's part and parcel of the monetary revolution. One of the reasons I got involved a long time ago. You can own Bitcoin. You can own it. You can actually own it. You can keep it for yourself. You can hide it away, not tell anybody. hold on to your secret keys and just hodl to 1 million. Maybe. I mean, 60-something thousand, man, that's a lot of money. I can't believe it. I was buying them for $70 in the beginning. Got a lot for 90. Yep. Sold a lot at 400. I'd 4x, 5x. I mean, come on, what more can you ask for? It is crazy. It is crazy. So of course, yeah, I just, the RFK Jr. thing, he is this guy, we're talking about chemtrails. We're talking about the jabs. We're talking about everything. We even have Zuckerberg coming out and saying, "Oh, I'm sorry, guys. I'm sorry." Biden, Harris made me do it. I regret it. I regret doing all those things. I'm sorry. He is sorry. Zuckerberg's not sorry. We are live on Facebook and Instagram. Thanks for letting us go live, Zuck. But probably if we didn't have X doing all the things that it did, they probably wouldn't let us. Who knows? I've never had any problems actually on Facebook. So I shouldn't talk bad about Zuck. Well, he did interfere in the elections, I think, definitely. Of course, Trump says if he does it again, he's going to jail, or he threatens jail. Of course, he threatened a lot of things last time. Nothing really happened. So hopefully, I was talking to my dad about it last night. My dad had his birthday yesterday. Happy birthday to Dad. He seemed pretty happy. It was good to talk to him. He has done better over the last year. He's very much improved. He had a congestive heart failure a few years ago, and I guess they put in a monkey valve in there, and I think it took him a year or two to think, okay, to realize, all right, this thing's gonna work. I don't have to worry about it. Now he stands up a bit straighter, seems a bit stronger. And it was great to see him last night. You do the video calls, and he was heading over to his buddies, longtime buddies I've known for a long time. And Mom and him were heading over there, and he was smiling, going over to buddy having a birthday party for him, I guess. It was cool. So he's 78 years old yesterday. I hope, my goal is to live to at least be 120. That is my goal. And I do things every day in order to do it. Every morning as I make my coffee, I have my Keurig. I drop down, I do, 50, 70 push-ups and sit-ups. I try to do that again during the day. So somewhere in there, the 150 range on each. Try to eat well, try to do the right things, try to keep yourself in shape so that you can, because stuff over the next little bit, guys, of course, that's one of the reasons I think that they're trying to knock everybody off, trying to get rid of everybody, is because indefinite life is probably already here, but not here for the normal people yet. But I mean, look at Dick Cheney, Slippy Dicky Cheney. The guy's got like the guy has had like 8 heart attacks or something like that. I mean, it's unheard of. Now he's got some nano heart or something. And you saw him. He came out and recorded that video. I mean, he looked like crap, really. But no, actually, he looked great, as a matter of fact. But indefinite life is not far away. They're going to start, bringing in a little bit of this, a little bit of that, little this, little that. Next thing you know, you're going to have people, instead of being 109 or 100, you're going to have people at 120 and then 150. Of course, Elon's going to have us on Mars by then. We're going to be on Mars. Traveling the stars, an interstellar species. That's the goal. That's what I want to do. I want to be an interstellar species. We don't want to be some species that never made it off of our planet. That's not very cool, right? That's not very cool. So crypto surge, market turbulence. We have the crypto surge. Of course, the big news coming out of the U.S. We're gonna have these PCE numbers tomorrow. They have been kind of floating. I've seen just come across in the news reports. Oh, the Fed might change this, or they might change that, or they might not do this, or they might not do that. I think it's baloney. They're gonna lower the interest rates. And the markets will pop. I did as well hear that BlackRock was buying their own ETFs. And then, of course, the market dipped. I thought, well, that's convenient, isn't it? That's convenient. That's pretty convenient. BlackRock wants to buy Bitcoin under 60 grand. They want to buy their own Bitcoin ETF under 60. Can't blame them, I guess. Of course, there's a lot of other factors that go into this, but these guys are operating on the big. They're operating on the big deal. Do you deserve privacy, or should a shadowy cartel who currently rules the world know all of your deep, dark, and light secrets? That's like a pretty profound question, and I think that we've been conditioned to just be like, well, whatever. The FBI knows everything. I guess that's okay. We got the Patriot Act. And what if there's some bad guys? I believe that we have a fundamental right to privacy as human beings. We have a fundamental right to privacy of our thoughts, privacy of our communications, and that we have a fundamental right to own things. These are like, when I talk about the monetary revolution around the world, I say, guys, it doesn't matter to me. This is over the last few years. Now everything's, I mean, if you're crypto, you're MAGA, right? I mean, it's just kind of like one of those things. In the early days, though, I was pro-Trump, and man, I mean, I took heat, man. A lot of those Bitcoin maxis, they didn't like me. It was like that. Not now. Not anymore. Now it's everyone. Everyone's on the gravy train. But we've gotten conditioned to think that we don't deserve privacy. And I like, and that's like, you look at Pavel Durov, right? And his arrest in France. If we're going to arrest people for things that people do on there, you know, like, I mean, the CEO of Delta should be arrested because there's drugs and human trafficking flying around the world on his plane, on that airline. The CEO of Toyota should definitely be arrested. I mean, shoot, you got ISIS and everything. They love those Toyota trucks. You got to arrest that guy. Very important. We have a fundamental right to privacy. We have a fundamental right to ownership. It's part and parcel of the monetary revolution. I used to tell people all the time, look, guys, there's three things that bring us all together, okay? I don't care who you voted for. We all believe in ownership. We all believe in privacy. And we all believe in freedom. And those are the three things about the monetary revolution that we all agree on. No matter where you are in the world, no matter what language you speak or who you worship, we can all agree on those things. So we need to take down the central banks and restart this. Let's talk the markets. I got my great man, my main man, Matt Dixon here. Sir Matt, how are you?
Hey, good morning, Bruce. Morning, everybody. How are you doing?
Doing great, man.
Good.
Feels like a Friday. It's Thursday, though.
It does feel like Friday. We're waiting for Friday.
Yeah.
So I've been, all waiting for the weekend. But tomorrow should be a good, well, hopefully will be an interesting day anyway. The markets are actually projecting an increase in PCE, which would be interesting. So this morning I've been taking a bit of a deeper dive into PCE and CPI and just wondering, why is it that the Fed prefer PCE rather than CPI measures? Any ideas? Whilst I see on the screen.
What was the last thing you said?
I was just saying, why is it that the Fed prefer to use PCE rather than CPI
probably it's more controllable. I mean, that's my knee-jerk reaction.
I mean, yeah, that's a good answer. It is actually more sensitive to changes, I guess, and maybe gives them better. I mean, there's lots of reasons and potential excuses, but actually, if you look at the data since about 1995, I think they started a true comparison between the two. Since that time, PCE has been consistently lower than CPI. So CPI is actually it measures inflation as at a higher level than PCE. So interestingly, they use CPI to set Social Security, benefit levels. So CPI is the higher measure, and they use that to set Social Security benefit levels. And PCE is the one they use to set interest rates. So I don't quite know why they use the different ones, apart from obviously using PCE makes them look better because it looks like they got inflation more under control than if they use CPI. CPI is better for benefits, people who are claiming benefits, because it means their benefits are increasing more each year than if they had used PCE, which they're using to set. So it really doesn't make a lot of sense to me as to why they would be using the different ones. But, the fact is CPI comes in higher than PCE consistently, has for all, every year, basically. So the other thing is, I don't know why they focus much on core. So core measures exclude food and energy. Now, we all know that a major part of our expense, our living expenses, are food, because we need it every day, and energy, because pretty much we need it every day. So those are things that we need and use every day, and yet they exclude those from the core. And I'm not really properly clear as to why they have that core measure excluding those, because it's not really relevant to us, is it?
No.
I guess so.
I mean, for the most part, yeah. I mean, that's like, that's for the average person. If you don't have, if you have obviously different assets and everything else, but for the average person who is spending what they make, pretty much, that's the what matters to them. They go to the store, and instead of a $200 bill, it's a $300 bill now, and that's a very real. I mean, I can tell you on my Costco run, it's about $100 more than it used to be.
Yeah. No doubt about it. Inflation has gone up a lot. So they're expecting, I think, a tick up in PCE tomorrow. So it was 2.6. It'll be the first time in a year it will have ticked up, if it ticks up tomorrow. I'm hoping and expecting that we'll get either probably flat PCE or maybe even a reduction, but I think flat. If it comes in flat, then that's actually a good outcome, better than expected. Anything, expectations are what really matter. And if we beat expectations, and a flat measure would mean we beat expectations, and that would be good for the market. So I think that very often when we run up towards these big data releases, and this is no doubt a big data release, very, very important for people. As we run up to it, there's a lot of doubt and uncertainty in the markets, almost FUD in the markets. And when the data comes out, hopefully better than expected, then the markets will take a big sigh of relief and hopefully take a move to the upside. So when we look at the markets,
that's when we go to the moon.
Yeah. So hopefully when we look at the markets, we'll see them treading water in a corrective manner, waiting for a big push higher. Let's hope so. So I've been looking though, because I'll just go to a couple of my X posts, but I've been looking, as I say, at inflation, at recession, at where we are. I mean, at the moment, things are looking reasonably good on the economy, which is why, of course, we're still seeing pretty much all-time highs on stock markets, S&P 500, Dow Jones, NASDAQ, there or thereabouts from all-time highs on those markets. And that is reflecting a reasonably positive stance on the economic front, that we're still there's still a possibility of a soft landing. A soft landing would basically mean that inflation comes down under control to that 2% level, and we still maintain stable growth and unemployment. And these are the main criteria that the Fed used to set interest rates. Basically, inflation under control, jobs, and the economy effectively. And they do actually, although I don't think it's explicit in the mandate, they do actually keep an eye on stock markets and want a stable stock markets as well. So they've got
they definitely market make.
Yeah. So they've got direct mandates that are stated, and they have kind of secret mandates which are not stated. And I think the markets are one of those kind of secret mandates that not explicitly stated, but they do keep control. So this little chart I got up, I assume you can see it, can you, Fred?
Yes.
Yeah. So it's just looking at the yields on US Treasuries, and it's lots of different lines, but you got the short-term 3-month and right up to going 1 year, 5 year, 10 year, 30 year. And it's not shown on this chart, but when you basically see that long-term rates are lower than short-term rates, it's telling you that's what's called an inversion of the yield curve. And what it tells you is that they're expecting the economy to slow down in the future. That's why they're saying longer-term rates will be lower than shorter-term rates. And that's the situation we've had now for a little while. And it's that sign is telling us that recession is coming. Whenever you do see an inversion of the yield curve, and if you studied these in depth, every one of these gray areas is a recession in the past. The latest recession was back in the COVID times, and that was maybe artificially induced, I'll say artificially, but because of the COVID crisis, not purely directly economic. But even so, we did get an inversion of the yield curve at that time. We have an inversion of the yield curve now. We've had it for some time. Normally that inversion disappears as recession comes on. And I think that may be beginning to happen. But all of these recessions have been predicted using yield inversions. So it's just very, very interesting. We have a yield inversion now. It's always been a predictor in the past. Almost the same chart as I've shown with unemployment, and also the SARM measure. Basically, when there's a certain particular measure regarding unemployment, when it ticks up, and it's a certain, more than 0.5% over the previous 12-month period, then that is a perfect indicator. Every time in the past, every single time without fail in the past, is indicated recession coming. So I still believe that recession's coming. I still believe that inflation will drop. I'm hoping that we don't see that terrible thing, stagflation, where we would see stagnant growth with inflation. I do hope and expect that inflation probably will fall. And I think we're actually going to re-enter a deflationary world again, as we had back in 2008, after 2008, and also at the COVID times. And that will bring about more money printing, no doubt about it. So maybe that will support markets in the future. But long term, as we discussed ad infinitum, it's not a long-term solution. It just stores up problems for future governments, future administrations to try to deal with. If you're printing money, creating money out of thin air, it doesn't create real solid economic growth. So I don't know how long they'll be able to keep going with the current situation, but at the moment, things are looking reasonable, as you would expect during election year. So that's taking a little look at, let me just see that, as I say, that's inversion of the yield curve. I'll just move on to perhaps a couple of others. PCE, this is one that we just discussed, wasn't it? PCE, I did say to you that PCE and CPI is the red line here, PCE is the blue line, and we can see that the red line has consistently stayed above. We briefly met together in early 2023, but it didn't really dip below. So consistently, really, we have seen CPI is much, much higher, consistently higher than PCE. And the Fed choose PCE as their preferred measure, and you can see PCE even now is much lower than CPI, substantially lower than CPI. So with that in mind, that gives us hope, and obviously we had Fair Chair Powell speaking hopefully about interest rate reductions coming, and we believe, the markets believe, I think it's 85% plus, I think, that we're going to get a 25% basis point cut on the 18th of September. So we're only 3 weeks away now. Hopefully, the first interest rate cut. And I do think that as we move towards that, assuming PCE remains under control tomorrow, that we're going to see the markets begin to rebound. As I said yesterday, I'm reasonably positive on the markets. So I'll probably move over to the markets. I mean, I've got lots of other charts I posted, but we will just refocus on this one again very briefly. This is the PCE expectation for tomorrow. So it was previously 2.6%. The expectation is 2.7%. That if it comes out at 2.7, that would be the first time in over a year that PCE would have ticked higher. Every single month for the past year, PCE has reduced, more than a year now, in fact, PCE has reduced or at worst remained stable. So if you were to see a tick up to 2.7, that would be a very bad sign. It would mean that the Fed have not got a grip of inflation and that they're going to have to keep rates higher for longer. That would change the expectations, the market expectations for interest rates. It would spin on a dime. It would turn immediately. So from 85% plus chance of a 25% basis point cut, that would change completely. That would be eliminated almost entirely. So this is why it's so important. This will affect, and I did have another chart. I don't know whether I can find it right now, but looking at how Bitcoin in particular is responsive to interest rate expectations. It is responsive. Bitcoin is now, and don't forget, most of crypto follows Bitcoin, and we've shown that with correlations in the past. Bitcoin is very sensitive to economic indications, and what that brings me on to
it's an emotional roller coaster. It's an emotional market. Bitcoin, very emotional.
It's very emotional, but it's also is driven by fundamentals. So that kind of brings me on to, it's changed over the years, Bruce. So we've seen it in the early days. It was purely emotional. It's purely speculative in the early days. But as it's matured, and especially now we have the ETF, there's still emotional, of course. All these stock markets and things, risk assets are emotional as well. There's a big element of emotion because emotion drives those, the fear and the greed. And that's what, drives markets. But don't forget, markets are also now a lot more algorithmically traded than they ever were. So
it's crazy, actually. I won't talk about the exact times, but I have some exact times during the day, and every day it does a routine.
Yeah, I mean, I've done a lot of research, and we'll probably go into that. I won't go into the research, but probably mention that in what I'm going to talk about today. But I've done a lot of research into what really affects the markets, and actually, technical analysis indicators, they're all lagging indicators, and they actually have no predictive capacity, no predictive ability in the market. But one of the few things that does have predictive capacity is timing. And it's interesting that you just mentioned that. Again, we haven't rehearsed this. You mentioned it. Yes. All the years of research have shown that timing does actually have a predictive effect on the market.
Yep.
So, there are
if you trade enough, you'll notice that.
Yeah.
Yeah.
Absolutely. Yeah. So, what I've got on here, I was looking into, again, because that's what that's what we're discussing now, is really lagging and leading indicators. Now, the only things that really affect the market moving forward are leading indicators. Lagging indicators, as the name suggests, are all based on lagging historical data. Now, we cannot predict on historical data future prices. We can make guesses, but those guesses, as I've mentioned it before, there's a book called A Random Walk Down Wall Street. It's written by who was it? Burton and Malkiel, 1973. That book was, again, they're renowned economists, and they basically did research into it and said that looking at historical prices, you cannot predict the future prices in the market. So that's lagging indicators. Lagging indicators include things like, well, specifically moving averages, and there's hundreds of technical analysis indicators. They're actually all pretty much useless, apart from possibly sometimes you can maybe identify extremes in trend, possibly. but effectively they're of no real value. But people still use them, but not to much effect. We know that all the retailers who use them and do all the study that they do, over 90% of retailers actually lose money. And so that just shows you that relying on TA is a conspiracy. They want you to rely on TA because they know it doesn't work. Market makers and people who actually whales who manage these market prices, they know what works, and what works for them is actually inside information. Inside information is knowing they know where positioning is in the market. That's the inside, that's the power that they have, and that's why they've got a big advantage when it comes to it. So if we just rely on TA, which is looking back at historical, that's no good at all. So the things that we have that we can use, as Bruce said, timing is well worth looking into. That's a really important one. Looking at cycles and timing and market opens, market closes. I mean, just a very simple example of that is when you've seen a strong move in the stock market, for example, and over the weekend, markets tend to be, markets are closed, then you very often see the market makers will move prices either just before close or just to open of the market. They'll move prices against that overall trend, and they do that in order to take out stop losses, and they can see where the stop losses are. And so that, whilst it's related to stop losses and then knowing positioning in the market, it actually works out as a timing effect. So when you see specific moves in the market, you can work out what the market makers are going to do effectively. So it's worth second guessing what they're up to. I've shown here all these little crosses are what are called moving average crossovers. Lots of people have used them, rely on them. They're actually useless. I have spent a lot of time and effort, and we actually had a computer genius friend of mine had a bank of computers churning the figures and all the permutations of various moving averages, every possible permutation of moving average crossovers over a whole long period of time using tick data, which is real stock market data. And we showed that there's no reliable pattern or predictive ability capacity whatsoever in moving average crossovers. Some people will swear on it, but I'm telling you, the science tells you it's utter rubbish. So moving average crossovers, and we can even see here, for example, we've got, this is a typical 9 and 21 period moving average crossovers. Every one of these crosses shows a crossover, and it's supposed to show a change in price direction. And we've got them, as I say, we've run these permutations, billions and billions of possibilities, and it doesn't have any predictive value. You can see these crosses turn up anywhere effectively, so you can't tell. But one here that is classed as a leading indicator, a leading technical indicator, is not strictly speaking leading, because what it is here, we've got RSI against price peaks. So RSI peaks against price peaks. I've talked about this many times. It's one that I do use, and it does predict turns in prices. But RSI does actually rely on price data to plot the RSI. So strictly speaking, from a technical perspective, divergence is still a kind of lagging indicator, but it does have certain leading indicator characteristics. And we have seen, for example, I've got Bitcoin here, and I'll show it again on Solana. But when we see divergences, so for example, we can see, here, I'll just draw the line in. I think I've already drawn the lines in on Solana, so we'll probably look at Solana in a minute, but just show you very quickly here. Actually, that would be a good one. That's to that peak to that peak. Yeah, we got a divergence there. It's basically showing, so it shows it's not perfect actually here on Bitcoin. So here we had a decline in price peaks and an incline in RSI peaks. They've got to be absolutely aligned, corresponding. It showed that price was going to decline. We did see price went a little bit higher, but then it declined very, very sharply. So it's kind of predictive there. I'll probably move on to, I'll just get rid of that one so it doesn't confuse us. I'll move on to Solana in a minute, but let's just see where we're at so far with Bitcoin. We've seen a bit of recovery because we did dip yesterday to, I think, the 57,000 area, upper 57,000s. So as Bruce said, it's been a bit of a mixed time, but we're seeing some nice movement higher. Now, as I said yesterday, and I'll reiterate this, we potentially have completed wave 4, which is big wave 4. We're looking for wave 5 higher to take us to new all-time highs. And next target for me would actually be ideally 84,000. So from that wave 4, we've potentially completed a wave 1 up in blue, 2 down in blue. And then within wave 3 in blue, that's also made up of 5 waves. So within the third wave, we've got wave 1 up, 2 down. Now it looks promisingly as though that wave 2 down is complete, because we started to move up quite nicely here. There's no overlap here. It's quite nice movement up that we're beginning to see in Bitcoin. But it's still not certain that it's complete. So as I said yesterday, the support is here, that wave 2. For this wave count here to be correct, we can't go lower than this wave 2. If we do go lower than that wave 2, then potentially this would be an A, a B, and a C lower. So wave 2 would move from here to drag that properly, from here to over here somewhere. So it doesn't mean a major change in the wave count. The big change would be if we were to break this low. This is the important, and that's why I've said strong support. I've labeled it here strong support. This is moderate support. It would just mean a minor change in my wave count here to move this 2 to over here. Doesn't make a lot of difference. But this one would be a major change. And it would tell me this is not a triangle, in fact. That big triangle that we've shown. Again, I'll just scroll out a little bit just to make it clear what I'm talking about. So this wave 3, wave 4 is a triangle A, B, C, D, E. Now, if we break that strong support there, it means this is not a triangle and it's some other kind of corrective pattern. I still believe it's corrective because it's all overlapping. So even if that's broken, I wouldn't expect much lower. It could still go a little bit lower. I still expect new all-time highs to come because this is corrective. We need to break the previous all-time high of 73,000 because it's corrective. It's against the trend. The trend is still higher. Being higher, it needs to reach new all-time highs. So if this were broken, the triangle is wrong, it then can be something like what's called a double 3 correction. So we basically get 3 waves down, an X wave, and then a further 3 waves down. So that would be A, B, W, X, A, B, Y. That is still a valid possibility. Could take us lower. So we need to be aware of these possibilities. We can use these levels, important levels, as risk-reward levels. So we can put buy trades just above them, losses just below them. So the potential loss is tiny, the potential profit is massive. Do the same here, and if we break this and get stopped out, then we would wait then for a termination of this wave down, and that would then be the WXY scenario, and then we would expect to push higher to new all-time highs. So what that means is I'm still really bullish on these markets, but we may even now may potentially have more downside to come. So I'm not certain about PCE. I am hoping that PCE comes in lower tomorrow. If it does, I think we're going to get a blast higher in these markets.
Yeah.
If it does come out as people expect and it's worse than people expect, then the markets still have lower to go. And it could turn out to be that worst case scenario, as I see here, lower to go, WXY. That could potentially take Bitcoin down to the low 40s, even mid to low 40s is entirely possible. But
wow, so, that would be something else, because like I said, with BlackRock buying their own ETF, that would just be music to their ears. That's exactly what they want.
Yeah, but I think that even so, I mean, it may be just, as we say, it's still a buy the dip opportunity, isn't it? So any of these dips, I mean, we can see currently from the all-time high, we are on a downtrend. There's absolutely no doubt about it. Looking over this time frame here, we're on a downtrend. Over a longer time frame, we're on an uptrend. But short term, we're still on a downtrend. So there's still potential for lower, quite a bit lower potentially. But even so, I know Bruce was saying if you leverage twice, well, with Bitcoin, for example, if you leverage 2 times, we're currently on around 60,000, then leveraging 2 times means you'd have to drop below 30,000 to wipe out. So at the moment, I think that's a safe bet. But don't take that as as gospel. Don't take it as financial advice. You need to take your own risk decisions. But I actually think that 2 times at the current level on Bitcoin, as I say, you need to drop below 30. Now that is you never know what might happen. We could get COVID too. We could get geopolitical. You don't know what might happen. So you have to bear in mind, whatever position you take, if you're leveraged, that is, whatever your position you take, you have to accept that some black swan event could happen and could wipe you out completely, entirely. So Bitcoin could theoretically go below 30,000 and wipe you out if you're on a 2 times position. But if you're not leveraged, I believe that you can hold your position no matter what. And I believe that Bitcoin is a great future, has a great future in terms of an asset as part of any well-diversified portfolio, and all those good reasons that we've had before, limited supply, et cetera, et cetera. So if you're not leveraged, I think it's a great bet. 2 times leverage. You've got to bear in mind, if the worst came to the worst and we got a black swan event that nobody can foresee, then you got to bear in mind that if it went below 30, you could lose your money. So just keep those in mind. But if you were to put an amount of money that you could potentially afford to lose, the likelihood is extremely small, very, very small, that you would lose your money on Bitcoin with a 2 times leverage, but it's a possibility. But if you went 2 times and we go to 84,000 from currently 59,000 or whatever, call it 60,000, that's 35-40% increase in price.
Right.
And if you double that, 80% increase if you did 2 times leverage. So tremendous.
It's powerful. It can be powerful.
Absolutely. And that would be like, I mean, potentially if you did 2 times leverage, again, I just need to keep reiterating this because I don't want people to take risks that they're not aware of. Be aware there's risk if you go leverage, but if you are leveraged 2 times and if the market went to 84, as I think is a good, strong possibility, then you can make 80% on your money. And I believe that will be in a matter of well less than a year. Now, to be able to make 80% on your money in less than a year is amazing. It could be life-changing depending on what you're talking about. But again, just bear in mind, if you're leveraged, there's always potential for a black swan event that could wipe.
Potential for a black swan event. And you don't put, if you have 100 grand, don't put 100 grand in there, okay? Because if just like 80%, it could be life-changing one way. If it's your last 100 grand, it can be life-changing the other way too.
Absolutely, yeah. So I actually don't think it's a good idea personally for retail investors to leverage. I don't think it's a sensible idea. And again, even so, you only put money that you're not going to need in the foreseeable future, because you never know what's going to happen with markets. But if you're not leveraged with Bitcoin, even if we dip to whatever it dips to, like in the COVID crisis, it dipped to something like 3,000 or 4,000, didn't it? And look at it now, it's 60,000. So even if it were to dip, as long as you're not leveraged, you could hold it, indefinitely, really. There's no cost to holding it. If you're not leveraged, there is no cost. You can just keep it in a wallet. You can keep it in an offline wallet, in a Ledger or a Trezor or any other offline wallet you've got. Absolutely safe and secure. It cannot be hacked in those offline wallets. You can just sit on it and wait till the price rises to a level that you're comfortable with. And the people who made real money, by the way, I know people who got into Bitcoin when it cost a few cents. Now, just imagine if they were to see it to dip to $30,000, there's still so much in the money, it really doesn't matter to them at all.
Yep.
The fact they got in at a few cents or just a few dollars, I think Bruce was in the early days. He made some good money in the early days. The fact that if you've been in, you could have cashed out some anyway at the high levels, and it wouldn't affect much in terms of your overall holding. So long term, I think Bitcoin is still one of the better potentials in the market. So that's Bitcoin. We looked at the support levels, looked at the potential, where we're going to go. As I say, I'm overwhelmingly bullish and positive, medium to long term on Bitcoin. Solana was showing some nice divergences. Again, I've put all the crosses there with the moving average crossovers. As I say, I exhaustively tested that as an indicator, and it wasn't valuable at all. So looking at divergences here. So there's lots of different divergences, and I put them on different time frames as well. But basically, there's, this is just to move up here. Just depends. It always changes when you change time frame. But basically, we can see a move up on prices here and a move down on corresponding RSI here. That signaled a sell-off precisely. So all these lagging indicators, these moving average crossovers, there's no particular indication. The last one here was a crossover to the upside. There was a crossover to the downside, actually, which was, it came in quite late. So this is the problem with lagging indicators. They always come in after the event. So the market has really started falling. So actually where this cross came in, the corresponding price was right down here. So if you'd taken a short trade there, you'd have actually got quite a big movement against you. So from, for example, on Solana, $175, price went up to 184. Okay, not that bad, $9, I suppose. But that was a short trade that would have gone against you $9 before it started moving into profit. That's, in percentage terms, quite big. When we've looked at this, the problem is even this cross, when you see this cross here, for example, you can just about see it. I'll probably open it out a bit. It looks like it's in a great position to tell you when the market is about to turn. But in fact, if you try to act on that cross, the price is already way, way lower, and then it's beginning to move higher before you know it. So they're just late. They don't tell you anything. But this divergence indicator that I use so often, and I've told you about so many times, is very, very, very good at predicting precise turning points in the market. So we'll look at this one again. This is what's called regular bearish divergence. So it tells you the market is likely to turn down from this point. So we saw higher peaks in price and lower peaks in RSI. What it's actually telling you is that volume in the market has decreased dramatically, even though prices are increasing. So it's not the big players, the big volume players that are pushing the market higher. This is smaller retailers who are still pushing the market higher. So it's on low volume, but prices are still pushing higher. So the big institutions already sold out at this point here and pushed the market down. Retailers thought this is just a minor correction, pushing higher, and the retailers are still piling in here, thinking the market's going higher. That's when the big correction happens, and precisely what has happened here, that we've seen this massive sell-off in the market following this regular bearish divergence. The next one we have here, there's a small one at the bottom. I won't go into this one in great detail, but this one was showing us where we got a turnaround into bullish divergence. So this was a small hidden bullish divergence indicating the price was going to move up, precisely what happened. The next one we see is from this peak here to over here, the peak here, the corresponding, so we got a decline in price peaks, an incline in RSI peaks. That is telling us of what's called hidden bearish divergence. So you need to learn all these indicators. You got hidden and you got direct or regular bullish and bearish indicators. There's 4 alternatives there. This one is what's called hidden bearish. It tells you the market's about to continue the decline that was shown from here to here. And that's precisely what happened on the dot. It happened. So this is one of the most accurate indicators there is. It's not 100%, but it's a high possibility. Now, if you had sold on this indication here of hidden bearish, where would you want to close? Well, precisely here, we actually got an indication of precisely where to close your trade. And it was here on the dot. So we got from the top to the bottom, we got precisely where to close the trade. So we got the maximum juice out of this market. The maximum profit you could make out of this move was made using this indicator. This was the sell indicator. And this one is basically a bullish divergence here. And it's actually a hidden bullish divergence, showing you that price is about to push higher, which is, again, precisely what happened. So you got the turning point right on the button there. And what it was basically higher lows on price and lower lows on RSI. So again, divergence, they're going in different directions, but this one is basically a hidden bullish. So this was a hidden bearish, this is a hidden bullish indicator. So again, whether it's hidden or whether it's regular or direct makes no difference. They're very powerful indicators. So you'd have got the most out of this market possible. So not only could you close this position, you could also then switch your position from short to long, and then you jump in long here, you're already in profit, and you can now actually protect that profit with a small stop loss. Just move that stop loss into profit slightly by even $1. Doesn't matter then what happens to the market, whatever happens to PCE numbers. If PCE comes in higher and we get a sell-off in the market, who cares? If you've actually got into this on the event of this indicator and then move your stop loss as it moves into profit, you can just take $1 profit. As I say, the most important rule of trading is don't lose money. So second rule is make money, and when you made your money, protect it and don't lose it. But the first rule has to be don't lose money, because if you lose money, it's really, really difficult. If you start off with $100, you lose 50% of that money, you go down to $50, then actually to make up back to the $100, you not only need to make up 50, you actually need to do 100% return to make up the 50% loss. That's just to get back the original $100. So making up losses is actually twice as difficult as making as it was to make the profits in the first place. So making up losses is twice as difficult as making profits, is what I'm saying. So to go from $100 to 150%, you make 50%. You still made $50, and you made 50% on the market. But if you're going from $50, you got to make back up to that $100. You got to make 100%. So hopefully you can see that comparison there. But to make up losses is twice as difficult to make up profits. So that's why the first rule of investing is do not lose money, or limit your losses. And that's why the one thing I would tell anybody, because nobody can tell the future, nobody can predict with certainty. The one thing I would tell anybody is please use risk and reward analysis as part of your trading strategy. I hear all of these people, as I say, what I call moon boys, coming out with their bullish moon talk about the market's going here, there, and everywhere. Whatever you do, don't listen to it. Just use risk and reward and trade sensibly, because trading is about discipline. It's about controlling fear and greed. And the moon boys are very much on the greed side of the equation. They're just looking at the upside, forgetting the potential downside. But you can also become overly focused on the downside as well. So there needs to be a proper balance there. And that's what proper risk reward gives you, that proper balance. It helps you understand what is the potential downside, what is the potential upside, what is the ratio between downside and upside. Then is this a sensible trade? If I place my stop loss here, is it a sensible place to put the stop loss? Does that represent a genuine support level? You cannot just do these things arbitrarily. You can't just say, oh, I'm looking for 3-to-1 risk reward, so I'll put my take profit 3 times higher than my stop loss. It doesn't work like that. You have to analyze the market, look for your sensible supports and resistances, and then work out your risk reward, and then place your trade. So there's a correct order to do things as well. You do all these things, as I say, Bruce has said, we have run trading courses. I do an awful lot on my X feed at MD Trade to try to educate people and help people, because you can make money out of markets. You just need to follow a few simple rules. So we'll just whip round very quickly around the markets. We're still seeing gold pushing up again. We're just about within touching distance now of all-time highs yet again for gold. Although we have, I think we've got some basically some regular bearish divergence in place. We've had it on a number of occasions. Again, if you'd acted on regular bearish, it's over a different time frame, probably daily, I guess. Yeah, it is. So if you'd acted on this regular bearish, if you'd followed those rules that I just told you about, the regular bearish was here at this point here. So you could have sold if you wanted. You could have even sold short. Once it moved into profit with this big red candle, you then basically just protect. You move your stop loss into a small profit, protect a bit of profit. And then even if price rises higher, as it has done so far, you can get stopped out and you don't worry at all about it, because you guaranteed your profit. We've had actually bearish divergences in place a few times along the way here. And every time it's happened, you could have put a short trade in and protected it. and being guaranteed that you don't lose money. So again, just abiding by that very first rule of trading: do not lose money. And you can use your indicators and stop losses, etc., to ensure that you do that. But gold is looking good at the moment. But again, it will depend on PCE. And we saw yesterday when we looked at the comparison of charts, gold against Bitcoin, there's been a divergence lately, and that represents the differing or the concern about the economy. Bitcoin has been effectively on a downtrend since that ETF was launched back in January, and we can see that effectively. From the ETF launch, we've seen a general downturn in Bitcoin, and that's just the uncertainty in the economy. And uncertainty is one where gold, when there's uncertainty, gold tends to be a hedge against uncertainty. And so when there's uncertainty in the world, in the markets, whatever, then gold appreciates. I think there's still going to be some time of uncertainty ahead. Obviously, even elections are an uncertain time. We don't know yet who's going to win the election. We don't know what their policies are going to be. We've still got geopolitical uncertainty. We've got economic uncertainty with interest rates almost pivoting. Are they going to rise? Are they going to fall? At the moment, it looks like they're going to fall, but do we get higher inflation? So there is uncertainty. Markets love certainty. So generally, risk markets like the cryptocurrencies generally like to have some kind of certainty. So that's why we're seeing a bit of divergence between gold price. Long-term, gold and Bitcoin have actually moved in the same direction, but since the ETF, there's been uncertainty in the economy on interest rates. Don't forget, the Fed was saying we're going to get 5 reductions in interest rates this year.
Oh, yeah. 5, and then 4, and then 3, and then 2, and then, well, we might do 1.
It might do 1. Who knows? Let's see what PCE comes out at tomorrow. So that's a general flavor of the market. We're seeing, interestingly, I will just look at this one, actually. This is dollar index. As you know, previous spike lows and tests of a particular price level that were rejected, price moved up sharply. DXY dollar moved up sharply from this level here. Interestingly, the other day we touched that level and then bounced up quite sharply again. So that's support. And this is what I'm talking about when I say risk and reward. Not many people trade DXY. You can trade it, actually. There's it's possible, but and you can trade it through currencies as well, very simply. But basically, this was a typical bounce area, strong probability. So risk reward, you basically would put you buy your dollar here, put a stop loss just below there, because this was a support level. If it dropped below it, yes, it's going to drop quite a bit lower, but the likelihood is it was going to bounce, which is exactly what it's done so far. And then right now, had you bought that level just around this dotted line here, had you bought that level, you can now protect it, move your stop loss into small profit. Then if we were to get strong PC numbers out tomorrow, then dollar is going to rally higher and you'd actually make loads of profit. But if we get weaker and PCE drops, then US dollar would drop also below this line. But if you've already moved your stop loss into a guaranteed profit position, you're in clover no matter what happens. So it's just good to be well prepared and trade in this protective manner, cautious manner, to protect your profits no matter what. Market's looking generally across the board positive. I can't see anything red there at all right now. Absolutely everything is in the green right now. So about time we had a bit of a bounce back. But all depends on tomorrow's. Again, back to Solana. We showed a couple of divergences there. The latest divergence, as I said, was basically it was, again, this one's over the 4-hour, I think. Yeah. So we had a bullish divergence here. It's actually a hidden bullish divergence here telling us to buy. So Solana's moved up quite nicely. We did get a dip down overnight to 140 level on Solana. We're right now on 145. So we've moved up quite nicely. So if you jumped in at that level, because we had this indicator, this bullish indicator, hidden bullish divergence. So you bought in there, you're now $5 in profit. You can actually protect a small amount of that profit no matter what. And as I say, we could move potentially quite a bit higher. So everything's looking good. We've got great gains across the board. ICP up over 3%, 3.2%. ADA, Cardano 2.8%. BNB, which tends to be a more stable, less volatile asset these days, still up over 1%. Looking at some of Bruce's favorites, I know ICP is one of them. Toncoin, again, it's continued its push higher. We will look at Ton very briefly. We did say we're expecting higher. That's precisely what's happened, and I think it should continue higher. But again, it's one of those that we had some support, we had some divergence here. So we can see here we got higher lows on the price and we got lower lows on RSI. That's telling us of hidden bullish divergence, telling us price should continue higher, precisely what it's done. So again, you enter on that indicator there. You now move your stop loss just below, by the way. You now move it just above into guaranteed profit. So price needs to move a long way down. But even if it moves down below this line, if we get strong PCE, you're still guaranteed. Now, just look at this in contrast. This is the moving average crossover. So we do have a moving average crossover here. That's precisely on the level we're at now. So although the cross is there, it corresponds to the price where we are right now, actually the opening price of this candle. So we are, it's where it is now. So effectively, it's telling you to enter into a long trade now. That's what this moving average crossover is telling you. But it's a bit late, isn't it? Because we had the first indication using my favorite indicator right down here, right at the close of this candle here and the open of this candle. That's where we got the indication. But moving average crossovers are telling you to buy right up here now. So we don't know where price is going to go. If we get a downturn, you're immediately into loss. And your sensible stop loss now would be right the way below this line here. In fact, below this spike here. So your stop loss would be at the previous low of 5.04 and the price now is 5.58. So we're talking about more than 10% potential loss if you enter using moving average crossover. That's a massive potential loss, more than 10%. If you leverage 2 times, like Bruce said, then that's a 20% loss on your money. You can't, and if you did lose that and got hit on your 20% loss, you then need to make 40% on your money to catch up to where you were. Yeah. So it doesn't make sense. These indicators, they're too lagging. So even this one here, it's telling you to sell. Looks fantastic, doesn't it? The cross is right up here, but no, it corresponds to the price right down here. It told you to sell precisely at this point down here. That's when this indicator told you to sell the market. Then look what happened to market. It rallied higher, put you into a massive loss situation, probably wiped out with your stop loss. It just does not work. So do not be fooled by these books and conspiracies about lagging indicators helping you to got so many people out there, got websites running, telling, going over technical analysis. It does not work. I've done the, not me, Nobel Prize winners have done the research, and lagging indicators don't have predictive capacity. So, as I say, focus on what does work. So, bit of a mouthful today. Plenty of talk about what we can expect for tomorrow. But as I say, hopefully give you some clarity on what indicators work and what don't, and help us to trade better for the future. So I hope that was helpful.
It is amazing. It is great. I hope people are following along. I hope you guys are watching. We are working on getting ways for more people to get involved.
Yeah, I know you've asked me to collaborate with that. I want to try to, I think it's important that we help people and educate people. There's no skin off our nose. In fact, it's what we love doing. We've been trading for many, many years. I've been trading for over 30 years now. It's good to pass on some of these tips. Great for us, great for our viewers. And hopefully let's continue pushing forward with that, with the website and everything that you're doing.
Yep, you got it. I'll talk to you about a site map and everything like that. We'll talk more.
Fantastic. Thanks, everybody.
Right, yeah, I'm gonna check out at the same time. Get the kids to school. So, cheers. Yeah. Thank you.
Catch up soon. Bye-bye.
Right. Bye.
Your voice is powerful. When combined with social engagement, it's a force for change. Decentralized media paired with free speech is the catalyst for an empowered world and a unified, invaluable ecosystem. Join Global Boost. Become a champion of free speech. and how to reshape the future of media.